We've been talking a lot about inflation on the financial news networks, and the latest reading that we got from the Consumer Price Index last week showed prices in the United States rising by 7.5% on a year-over-year basis. And you don't need to look farther than this chart to know prices are increasing. But that 7.5% figure is a little bit of a nebulous number. What does that mean for the average household? Well, our next guest has actually crunched the numbers and says that inflation at the levels now are costing the average American household $276 per month. Ryan Sweet is that analyst from Moody's Analytics, Senior Director of Economic Research. Ryan, great to have you on the show this afternoon. Tell us a little bit more about how you arrived at this number. Where are the categories where American households are seeing the sharpest price increases?
What we did is we looked at the consumer expenditure survey. It has a lot of granular detail on household spending patterns. When we look at the average basket that consumers were purchasing in 2020, and then we look at what's the difference between their expenditure patterns based on inflation at 7.5% versus 2.1%, which was the average in 2018 and 2019. And that difference adds up to about $276 per month, which is a big burden on households. But again, this is average. Everyone's consumption basket is different. So, for example, if you look at my household, we're feeling the pain of higher diaper prices a lot more than many others. But those at the lower income part of the distribution, they're feeling a lot more of a cost because of their spending patterns on gasoline and energy, other energy-related goods. Whereas higher income households, their costs, there's still a noticeable cost around $200 per month. But it's less of a burden than on the lower end of the income distribution.
Yeah, no question. Energy, gas specifically, a big pain point for a lot of Americans. I wonder where rent falls into that category. How big of a jump have you seen if you're looking on average?
We haven't seen a lot yet. And that's partly because of measurement issues. So rents that we're seeing now, if you look at alternative data, the real-time data on rents that Americans are paying, they're going up very, very quickly. That won't show up in the Consumer Price Index, which is that the measure from the the Bureau of Labor Statistics, that 7.5% that we referenced earlier. For another few months, rents measured by the CPI will probably peak this summer at 6% year over year, which is a pretty sizable increase. That's going to offset some of the disinflation that we're going to see from the goods segment of the economy. Because when you break down that 7.5% year-over-year gain in the Consumer Price Index, a good chunk of that is in energy, probably 2 percentage points. Another 2.5 percentage points are coming from supply chain constraint components. So think audio, video, new and used cars. And that's really driving a lot of the inflationary pressures that we're experiencing today. So if you strip those two parts out, supply chain issues and energy, we have inflation overall running around 3%, which is elevated relative to the Fed's target, but it's not a glaring disconnect as what we're seeing today.
Ryan, when people think about inflation, they, of course, think about the price tags that they see at the store when they buy goods. But how about for services? Because there's an argument that as the economy reopens, people feel comfortable going out again. Maybe some of that shift will go over to services, and that could be disinflationary if prices are lower. But just anecdotally speaking, the price of my haircut went up. So are services also seeing these types of trends?
We'll start to see more service inflation this year. So we're going to see the pandemic really roiled spending patterns. So for the most part, pre-pandemic, consumer spending was pretty much the bulk of it was in consumer services. So haircuts, sporting events, movie theaters. With the pandemic, people hunkered down, and that led to a shift in consumption away from services to goods. So stuff. We're buying a lot of things, cars, bedding, furniture. And that drove a lot of those prices. So goods prices really jumped. And that's been where the bulk of the inflationary pressures have been coming from recently. That's going to flip. So we'll see services inflation accelerate, but at the same time, we should see goods inflation really begin to moderate. So it's going to be slowing, which is disinflation. So on net, I think by the end of the year, we should see growth in the Consumer Price Index go from 7.5% where it was in January down to closer to 3.5% by the end of the year.
Moody's Analytics Senior Economist Ryan Sweet. It's good to talk to you today. Appreciate you stopping by.